This is our Forex blog for June 30th, 2011. And like most days, we really want to trade the strong currencies against the weak currencies. And you can see, the dollar is extremely weak coming into today. The daily, weekly, monthly trend are down. The yen was pretty strong. The euro has been consistently strong the last few days. The Australian, the last 2 days, has also been super strong. So, you can be looking to buy the Australian against the dollar. The Swiss happened to be weak last night. You could trade that against a strong yen, strong CAD, and strong Australian. Um, so let's first, let's look at some of the currency charts up here and just go over some of our systems. Coming into today, the euro trend was up. It was above the previous day's high. It's kind of, going sideways up here. This is one of our patterns. We have pullbacks or sideways consolidation breakouts. This is a sideways consolidation breakout. You get in here, and the trailing stop was already long. As of right here, if you wanted to anticipate a potential breakout, you could have went long right here at 68. Anytime it goes sideways for 2 hours, usually the trend's going to continue. That's basically telling you that there's no one selling up here near the highs. If there was, it would have pulled back more. It would have, came down and retested the previous day's high at a minimum. So this was very likely to go up, and it also is very likely to go to the Fibonacci profit target, which you can also use as an exit. Notice it pretty much tagged the 1.618 fib target to the exact amount, and our trailing stop, I believe, got you out of this trade right here around 95. You're in that trade at 71. And the euro dollar's been going up a lot, so it's usually, after a currency's gone up 3, 4, 5 days, it's usually best to wait for some kind of a pullback, at the very minimum a two-wave pullback. So you had this move down right here. This is a pretty high probability place to buy. It didn't really result in much profit. It went up 10, 15 pips. And when they don't really take off, the trailing stop's designed to kind of keep you into that trade for a while. And if you would have bought here, it got you stopped out pretty much right where you got in it. You have a retest here at the hourly, and it's usually kind of a risky trade, but when it goes back above the hourly and doesn't really come back down, it goes sideways. This trade right here is very high probability, and you can see our trailing stop got you out here at 14. So that's about a 30 pip move. It's always best to wait for the weakness to end. Initially there's some weakness, 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 and as it's going sideways right here, there's not much weakness compared to the statistical strength on the up moves. If you have up moves that have a lot of intensity and very little intensity on the way down, it's very likely to go up. Now again, the euro had brief amounts of strength. The CAD was very strong all day, but the dollar also was relatively strong. A good trade against the CAD would have been the Swiss, which was consistently weak all day. These are the pretty much no-brainer trades. Super strong CAD, super weak Swiss, and this is what you get. You have a multi-hour sideways range right here that breaks out from underneath to above the hourly, and there's a great entry right here. Trailing stop gets you out right here at 23. So in this case, you made about 23 pips. Again, it's usually best to wait for some kind of a pullback. If you bought in that trade right here, you pretty much broke even or maybe lost 5 or 6 pips. And it's right near the upper band. It's usually the best idea to wait for a breakout over the high, or at least give it some time to come down and go underneath the previous day's high. That would tell you that it's not quite as strong. The next place to buy is the hourly. And it never, even touched the hourly, nor did it go, the previous day's high, nor did it break underneath there. So when it broke out here is a very high probability trade. But it just didn't take off the first time. So you got into a trade, your trailing stop had you out pretty much near break even. Pull back again. We have a narrow range pattern right here when it broke out. And R7 patterns are very high probability trends, especially in the direction of the longer term trend. You bought right here, and it pretty much rode it all the way up until right here. This was the exit. And that's why we call it the FX and telestop. When there are big moves, it pretty much keeps you in, and you can snag 80-90% of the move. 87.67 is where you got out. So you made more than 100 pips on that trade. Outstanding. And it's not like it wasn't projected a mile away. The CAD was strong all day. The Swiss had some weakness. Then it had some choppiness here. But you can see the strength, pretty much never hit the 80 line, and then it got less, and then it got less. Pretty safe to assume this is almost telepathically telling you what the direction is. Extreme weakness, less strength, kind of chopping around. That extreme weakness is likely to continue, and it does at 7. And from 7 on, you wanted to be looking to buy this. Now again, at 7 o'clock right here when it broke out, you had a small win. The second trade 2 hours later is the one that took off. And the trailing stop really helps you, stay in this trade. Here's our regular chandelier stop, just to give you an idea of how much better the intelligent one is. The regular trailing stop got you out here at 34 versus 65. And it made an extra 30 pips compared to the regular stop. And so that's pretty, mighty difference. Even an extra 3 pips here, 5 pips there, 10 pips occasionally, makes a huge difference if you take 10, 20 trades a week. So one 30 pip move is an outstanding improvement over the regular and non-intelligent trailing stop. We use our statistical tools to calculate that trailing stop. That's why it's so good. All right. The Australian was strong all day today, so obviously, buying the strong Australian versus Swiss, also pretty much a no-brainer. You can see this one was above the hourly. Went sideways here and broke out. You're in, small profit, pullback trade right here, in, small loss. You get back in again here. And notice, I got you out all the way up here at 16 in this case versus about 9378. So it made about another 10 pips than the other one. But, if you're looking to do a counter trend trade up there, usually when it's above the upper containment band, don't get greedy. Just draw a fib off the last little wave and get out at the fib target. Most of the time when it's way above the upper containment band, that's the end of the move. You don't need to let and give back 25 pips in this case. And you might even lightly go short and then use the trailing stop to get you out right here. Not only did you ride it up, you rode it all the way down to 9027. So that was an astronomical counter trend move too, because it went up statistically way too much. When they're way over the band like that, 50 to 100 pips, you're going to get a 30 to 50 pip minimum pullback the vast majority of the time. All right, so again, the yen was also strong last night. You could have traded that against a weak one. Swiss pound for most of the night, selling the pound yen, selling the Swiss yen. Here's the Swiss yen. It's underneath the hourly. It's going sideways, breaks down, you go short, get you out here with about a 30 pip profit. I prefer some kind of a pullback. But if you sold every one of these, you lost a little bit here, you lost a little bit here, you got short again right here, and that's the trade that pretty much locked you in to the whole thing, got you out at 72 versus 82. Again, caught another 10 pips on that big move. And the reason this works so well is that when the market's so weak, we keep the stop wider away. As soon as that weakness disappears, we yank the stop down, allowing you to catch the majority of the moves. And again, fib targets, this thing went down, kind of went sideways, started to go down and kind of went sideways right here. I'd draw my fibs off this little sideways move and exit somewhere down here. Even if you got out to 1.38 fib target, it still got you another 8 pips more than you would have letting the trailing stop get out. And if you waited for the 1.618, you pretty much nagged every pip. So there's a lot of things to learn as traders, but the more experience you have, the more you realize that most of the time the Fibonacci profit targets are the perfect exit.